What if you could buy a piece of a luxury apartment in Dubai, a commercial building in New York, or a beachfront villa in Spain for as little as $100? What if you could sell that ownership stake instantly, 24 hours a day, 7 days a week, without any lawyers, without any banks, and without waiting months for a transaction to close? This is not science fiction. This is real estate tokenization, and it is happening right now in 2026. Tokenized real estate assets surpassed $10 billion in 2025, and projections estimate growth to $1.4 trillion by the end of 2026. Analysts forecast the market will reach $3 trillion by 2030, representing roughly 15% of global real estate assets. And by 2035 the tokenized real estate market could reach $4 trillion. In this video I am going to explain exactly what cryptocurrency and blockchain technology are doing to the real estate industry, how tokenization works, what the biggest platforms are, what the risks are, and what this means for you as an investor in 2026. Let's get into it. First, let me explain what real estate tokenization actually is, because this is the foundation of everything. Real estate tokenization is the process of converting a physical property into digital tokens on a blockchain. Think of it like this: imagine a building worth $10 million, instead of one person or one company buying the entire building. The building is divided into 10 million digital tokens, each worth $1. Anyone in the world can buy any number of those tokens through a blockchain platform, and each token represents a real legally verified fractional ownership stake in that building. The token holder earns a proportional share of the rental income generated by the building. And when the building increases in value, the token increases in value too. These tokens are recorded on a blockchain, which means ownership is transparent, secure, and tamper-proof. When you want to sell your tokens, you can list them on a secondary marketplace and sell them instantly. Compare this to traditional real estate. In traditional real estate, if you want to invest in a building, you need enormous upfront capital. You need lawyers, you need title agents, you need banks, and the entire transaction can take months to complete. Selling your stake requires finding another buyer, repeating the entire legal process, and waiting for settlement. Tokenization eliminates most of these friction points. It brings the same speed, transparency, and accessibility that we see in stock markets to one of the world's oldest and largest asset classes. Now let me explain the technology that makes all of this possible, because understanding the mechanics will give you a much deeper appreciation of why this is such a significant development. The entire system is built on three core technologies working together. The first is blockchain. A blockchain is a distributed digital ledger that records transactions across thousands of computers simultaneously. In real estate tokenization, the blockchain serves as the definitive ownership record. When you buy a real estate token, your ownership is recorded on the blockchain permanently and transparently. No single company or government controls this record. No one can alter it or erase it, and anyone can verify it at any time. The second technology is smart contracts. Smart contracts are self-executing programs stored on the blockchain that automatically carry out predefined conditions when specific criteria are met. In real estate tokenization, smart contracts handle everything automatically. They distribute rental income to token holders every month without any human intervention. They enforce transfer restrictions, ensuring only verified investors can purchase certain tokens. They conduct compliance checks automatically, and they execute transactions without any intermediary. The third technology is token standards. Most real estate tokens in 2026 are built on Ethereum using token standards like ERC-20 for fungible tokens, where every token is identical, or ERC-3643, which is specifically designed for compliant security tokens with built-in identity verification and transfer restrictions. In 2026, Ethereum remains the dominant platform for real estate tokenization because it combines the most mature smart contract infrastructure, the deepest liquidity, the strongest developer ecosystem, and the most institutional trust of any blockchain platform. Now let me compare tokenized real estate with traditional real estate investment in detail, because the differences are transformative. Problem 1 in traditional real estate is high capital requirements. To directly invest in commercial real estate, you typically need hundreds of thousands or even millions of dollars for a down payment. This locks out the vast majority of ordinary investors from one of the most wealth-generating asset classes in history. With tokenized real estate, the minimum investment can be as low as $100. This democratizes access to premium real estate assets for the first time in history. Problem 2 is illiquidity. Traditional real estate is one of the most illiquid asset classes in existence. Selling a property typically takes 30 to 90 days at minimum and involves significant transaction costs. with tokenized real estate you can sell your tokens on a secondary marketplace instantly, just like selling a stock. Liquidity transforms real estate from a locked asset into a flexible investment. Problem 3 is geographic barriers. In traditional real estate, investing internationally is extremely complex. It involves foreign ownership laws, currency exchange, local legal compliance, and in many countries restrictions on foreign ownership entirely. With tokenized real estate, a retail investor in London can own fractional stakes in properties in Dubai, Singapore, or Miami with the same ease as buying a stock. Smart contracts handle all compliance requirements automatically. Problem 4 is transparency. In traditional real estate, transactions involve significant information asymmetry. Buyers and sellers have different information and intermediaries control critical data. Blockchain makes every transaction, every rental income distribution, and every ownership transfer publicly verifiable in real time. Problem 5 is settlement time. Traditional real estate transactions settle in 30 to 90 days. Tokenized real estate settles in minutes on the blockchain. Now let me look at the biggest real-world examples of real estate tokenization happening in 2026, because this is where the theory becomes reality. The United States, United Arab Emirates, and United Kingdom are leading global real estate tokenization adoption in 2026. In the United States, the regulatory environment has transformed dramatically. The Genius Act passed in 2025 established the first federal regulatory framework for stablecoins, making it much easier to use stable digital currencies. For property transactions, the Clarity Act, which is advancing through Congress in 2026, will provide comprehensive market structure rules for all digital assets, further accelerating institutional adoption. Several institutional-grade platforms are now operating under registered frameworks with real regulatory certainty from the SEC. In the United Arab Emirates, the Dubai Land Department has been one of the most progressive real estate tokenization regulators in the world. The UAE has established clear frameworks for tokenized property ownership, and multiple platforms are actively tokenizing premium Dubai real estate, making it accessible to global investors with as little as $500. In the United Kingdom, the Financial Conduct Authority has been developing its digital securities sandbox, which allows regulated tokenization platforms to operate under supervised conditions. Platform examples in 2026 include Realty, which allows investors to buy fractional ownership in rental properties in the U.S. starting from as low as $50 per token. Investors receive daily rental income payments in stablecoins directly to their wallets. The global tokenization market for real-world assets on public blockchains reached $18 billion in total value in 2026, demonstrating that tokenization has moved from hype to the new normal. Now let's talk about the institutional adoption story, because this is what is driving the explosive growth in real estate tokenization in 2026. For decades, institutional investors, including pension funds, insurance companies, and asset managers, have wanted exposure to real estate as a portfolio diversifier. Real estate provides stable income, inflation protection, and low correlation to stocks and bonds, but the high transaction costs, illiquidity, and operational complexity of direct real estate ownership have been significant barriers for many institutional investors. Tokenization solves all of these problems simultaneously. Research shows that 65% of institutional investors expect allocations to tokenized assets by 2026. Institutional investors expect to allocate 5.6% of their portfolios to tokenized assets by 2026. High net worth individuals expect to allocate 8.6% of their portfolios to tokenized assets by 2026. Both high net worth investors at 49% and institutional investors at 56% cite real estate as their second most attractive tokenized asset investment option after government bonds. Over 200 active real-world asset token initiatives are currently active, with participation from more than 40 major financial institutions. Growing participation from asset managers, hedge funds, and private equity firms is accelerating the professionalization of the tokenized real estate market. This is not retail speculation. This is institutional capital recognizing that tokenization is the most efficient way to access and manage real estate assets at scale. Now let's talk about how you as an ordinary investor can actually access tokenized real estate in 2026, because this is the most practical part of the video. There are three main ways to get exposure to real estate through cryptocurrency and blockchain. Option 1 is direct property tokenization platforms. These are platforms that tokenize specific individual properties and allow you to buy fractional ownership tokens directly. When you buy tokens on these platforms, you are buying a legally verified fractional stake in a real physical property. You receive proportional rental income distributions automatically through smart contracts. Platforms in this category include Realty for U.S. residential rental properties, Lofty AI for fractional real estate with daily rental distributions, and Labs Group for Asian real estate tokenization. Option 2 is real estate-focused DeFi protocols. Some DeFi protocols use tokenized real estate as collateral for lending and borrowing. You can deposit your real estate tokens and borrow stablecoins against them without selling your property exposure. You can also earn yield by providing liquidity to real estate-focused lending pools. Option 3 is real-world asset tokens on major exchanges. Several tokenized real estate products are now available on regulated centralized exchanges. These provide the simplest entry point for investors who already use crypto exchanges but want real estate exposure. Before investing in any tokenized real estate platform, always verify that the platform operates under a recognized regulatory framework, that the underlying properties are legally verified, that the smart contracts have been audited by reputable security firms, and that the rental income distributions are backed by real rental revenue from real tenants. Now let's talk about the risks, because tokenized real estate is not without significant challenges and you need to understand them before investing. Risk 1 is regulatory uncertainty. While the US, UAE, and UK are leading on regulation, many jurisdictions around the world still have no clear legal framework for tokenized real estate ownership. In some countries, tokenized real estate may not be legally recognized, meaning your token may not give you enforceable property rights. Always verify the legal jurisdiction of any platform before investing. Risk 2 is smart contract risk. Smart contracts are only as good as the code they are written in. A bug or vulnerability in a smart contract could result in loss of funds or incorrect income distributions. Always check whether the platform's smart contracts have been audited by reputable security firms. Risk 3 is platform risk. Most real estate tokenization platforms are relatively young companies. If a platform ceases operations, your tokens may become illiquid or difficult to manage. Prefer platforms with established track records, institutional backing, and regulated status. Risk 4 is liquidity risk on secondary markets. While tokenized real estate offers better liquidity than traditional real estate, secondary markets for property tokens are still significantly less liquid than stock markets. For smaller or less popular tokenized properties, you may find it difficult to sell your tokens quickly at a fair price. Risk 5 is valuation risk. The value of real estate tokens ultimately depends on the underlying property value and rental income. Real estate markets can decline, rental income can fall if properties become vacant, and token prices can drop significantly in a real estate downturn. So let's bring this all together with everything you need to know about cryptocurrency and real estate in 2026. Real estate tokenization converts physical properties into digital tokens on a blockchain, giving anyone in the world fractional ownership of real estate assets with as little as $100. The technology stack includes blockchain for permanent transparent ownership records, smart contracts for automatic income distribution and compliance, and token standards like ERC 3643 on Ethereum for compliant security tokens. The advantages over traditional real estate are transformative. Low minimum investment starting from $100 versus hundreds of thousands required traditionally. Instant liquidity versus 30 to 90 days for traditional transactions. Global access without geographic barriers. Full transparency through blockchain, and automated operations through smart contracts. The numbers confirm this is a genuine trend. Tokenized real estate surpassed $10 billion in 2025, is projected to reach $1.4 trillion by end of 2026, $3 trillion by 2030, and $4 trillion by 2035. 65% of institutional investors expect tokenized asset allocations by 2026. Institutional investors plan to put 5.6% of their portfolios in tokenized assets. The USA, UAE, and UK are leading global adoption, with the Genius Act providing stablecoin clarity and the Clarity Act expected to provide comprehensive digital asset regulation. The risks include regulatory uncertainty in some jurisdictions, smart contract vulnerabilities, platform risk, secondary market liquidity, and property valuation risk. Always do your research, verify regulatory compliance, and only invest what you can afford to lose. If this video helped you understand how crypto is changing real estate, please hit the like button and subscribe to the Crypto Skill for more videos like this. Drop a comment below and tell me, would you invest in tokenized real estate?